Basically, if you look at the numbers, they were actually quite strong. So how do you think, Mahantesh, how do you see the real numbers? Do you think there was any fall in the numbers, or do you think any kind of surprise was seen in the numbers?
So if you look at the quarter-on-quarter number, when you look at the segmental results, something in terms of the result seems to be a little haywire because, treasury income is quite substantially grown higher, while the traditional banking business, both retail and wholesale, seems to have dropped quarter-on-quarter. So the numbers seem a little wonky. I don't know what are the internals related to that. And the comment chiefly on the asset quality seems to suggest that the net NPA ratios have actually worsened quarter-on-quarter basis by just about 2 bips. That's not materially large, but that tells you that they are at the bottom of the asset quality cycle, and here onwards you would reckon that asset quality will start worsening.
Another question I have for you is that if you look at the provisions, the floating provisions were made around 10,900 crore levels, and at the same time, if you look at the balance sheet borrowings, I think, if I'm not wrong, they were down almost 10% on a quarter-on-quarter basis. So how do you see these numbers? Do you think the overhang which was there on the share price, do you think this will get over after the results?
See, the share price overhang is one aspect, but let's look at the fundamental performance itself. The fundamental performance tells me that the balance sheet worries continue to remain. You did talk about the deposits seem to have apparently sort of fallen quarter-on-quarter. I need to understand these numbers internally quite properly. But having said that, one thing that stands out very clearly is that neither the traditional profitability drivers such as NIMs, such as NPA, such as cost to operating ratio have seen any material improvement for the bank to suggest that the merger has really has come out really well. The HDFC Bank HDFC Limited merger is something which doesn't seem to have provided the intended boost.
And the last question I have for you is that now you know that management was actually focusing more on profitability over loan growth that the management had also highlighted earlier. And now that we have seen these kind of numbers, of course we are definitely waiting for the management comments. But initially, do you think the ROA of 2% is something that they can manage from here on? What are your expectations from HDFC Bank, from at least the initial numbers that we have seen?
So, like I told you that I don't see any improved trajectory onwards in terms of the profitability drivers, which we discussed. If they are continuing to make floating provisions, it also points to the fact, which I alluded to earlier, that the asset quality cycle is turning for the worse for them, and therefore probably they are preparing for that. So this suggests to me that the improvement direction and it doesn't exist. ROA at 2% is not a great number to really look at. Even the large public sector banks are now achieving that an ROA number which is close to 2%. If HDFC Bank also achieves a similar number, then why should one pay a huge premium to it? That's the question that we are left with.
Thank you, Mr. Sabarad, for joining us and, of course, helping us understand all of those numbers. Thank you, Gaurav, as well, for joining us. So, Mahantesh, Sabarad, the independent market expert, saying that the HDFC merger hasn't quite provided the much-needed boost to the bank. In fact, he also says that asset quality cycle, he's not very happy with asset quality cycle. So, those are some of the initial comments coming in from market expert Mahantesh. In fact,
if you like this video, then like, share and subscribe to ET Now.